What's happening, guys? Welcome to another episode of Coffee Pump. We're again at Bow Box on Spring Valley. Today's episode, I wanted to focus on financial well-being. I really want to know what to do with my money. Where should I put it? The psychology behind investing. There's a whole aspect of it which I'm not familiar with. And so today, we have a special guest. We have Macharia from Abacus Wealth. Welcome, bro.
Thank you, man.
Why don't we start off? Why don't you give me a brief introduction into who you are and what you do?
So my name is Ng'ang'a Macharia. I'm the founder and CEO of Abacus Wealth Management, a business I started 10 years ago. It's turning 10 years this year. And the mission and the vision of Abacus is actually to help as many people as we can get to a place in their lives where money is not the primary concern or the primary determinant of what they do with their time.
Okay. I mean, for a lot of people, I guess they revolve their life, and I'm at fault as well. We revolve our life around what do I do with my money? I need money. I mean, do you think maybe it's to do with our Kenyan culture of wanting to drive Prados, wanting to drive big cars, wanting to drive big houses?
Oh man, it's not just about Kenya. I mean, it's global. It's capitalism, right? So we've kind of grown up and exist in a society where without money you really can't access anything. You can't access housing. You can't access decent housing, decent transportation, and so it's a fundamental aspect of the way the world is built today.
Correct.
Where it's you're trading your time for money or money for time.
Yeah.
And those two being like the two main things that kind of capitalism is built around. So it's not a unique problem to Kenya. It's just it's become the global phenomenon.
How did you get into this field, brother? Like, what sort of led you into it?
Money has always fascinated me, not necessarily in the sense of wanting to have a lot of it, but rather in the way that it impacts people's lives, in the way that so much of our lives are determined by how much money we have or how much money we're trying to make. Development of our country is also based on how much money can we raise as a country, how much is getting stolen because people are trying to enrich themselves. So there's a lot of these things about money that has always fascinated me. But it actually started, I remember very distinctly, when I was about 14 years old, I went to visit one of my uncles for the first time and I saw this massive house that he'd built. And I remember thinking, man, where'd you get the money to build something like this?
Yeah.
And of course, as a 14-year-old, I don't really have like social graces. So I walk up to the guy and ask him, how do you get enough money to build something like this, which in African tradition is considered quite rude?
Quite rude. Yeah.
Thankfully for me, he actually found it to be a very entertaining question. And he was a banker at the time. And he introduced me to the concept of other people's money and how banks actually utilize money that doesn't belong to them. They take your deposits, lend them out, create profit.
Fractional reserve banking?
Exactly, right? Okay. So he introduced me to the concepts of banking, to the concept of other people's money, to the concept of credit, to return. And we had a fascinating conversation. And since then, the idea of how money works actually became very interesting for me. But the second significant thing that happened is when I was in high school, in my last year in high school, we got lucky and we were taken to the Nairobi Securities Exchange for a visit. And back then it was open outcry. It was at the Nation Center. And you've got all these guys with red jackets and green. Again, they're just shouting at some guy on a whiteboard. And I was sat next to the teacher who'd actually taken us there. And he was showing me his calculations and telling me I just made about 40,000 shillings on that particular trade. And I asked him, how did you do this? And he explains it to me. And it felt like he'd made money out of nothing.
Correct.
Right? Yeah. Because he'd put in 20,000, now has 60,000. He's done nothing himself. It's just, the money's grown. And so that triggered my love for investing. Just trying to get to understand how it works. Because ultimately I got to understand that if I could get to the point where my money is making itself, then I can do what I want. I don't necessarily have to dedicate my entire life to making money.
Which is a concept not many folks are familiar with because the traditional norms of making money are the buying and selling aspect. I buy something, I sell it.
Yeah.
And as long as I'm able to do that, I'm able to generate wealth. The problem that therein lies is when you become old and senile and you have nothing to sort of make from it, how does your money work for you rather than the opposite, right?
Right, yeah.
Okay, interesting concept. So,
and a huge chunk of, when you think about it, a huge chunk of kind of the financial advice, the financial systems, the financial processes that we implement in the country are based on Western economies. And so you'll find things like the concept of working for 40 years until retirement, which is typically like what a lot of our parents might have done, but something we can't actually manage to do, came from, economies where people got a job and you stuck in it, and you could leverage that to get mortgages. You could leverage that income from these salaries to actually grow your wealth. But those kinds of systems don't necessarily work in these markets because, there's no transition from school to employment. So there's entrepreneurship. There's quite a lot of friction. And so over the last 20 years, because I've been studying this over the last 20 years, it's just kind of trying to get to understand what are the principles that came, like from banking, from investment banking in places like the US, the UK, and wherever else we might borrow this from, and how do they apply to the situations that we
currently
have locally.
If you'll allow me, fractional reserve banking.
Yep.
I've heard that concept go through. In fact, if you're an Andrew Tate dick rider, like some of us over here, basically, he's been very vocal about it. It's a concept that's still very unfamiliar to me.
Yep.
Could we perhaps talk about that, where the underlying aspect is banks make money from nothing. And so the concept of money is actually, it's fugazi, it's fairy dust, right?
Money is actually the one thing that, it's a piece of paper that, when I give you 100 shillings, you and I have to believe that it is worth 100 shillings because it's 100 shillings written on it. And especially now that it's all become digital, it's become a concept of, we agree that the numbers on this little app are actually numbers that can change my life. This is money that I've received. And all it's become now is a bunch of numbers. With fractional reserve banking, what happens is that the banks will take in deposits from quite a number of people. So let's say banks might actually have 10 billion in deposits, right, that they've taken in from people. And the reason why people are depositing their cash is because it's easier to transfer it. It's easier to actually keep it safe because you don't want to be sleeping with 10 million shillings under your mattress, man. It's going to be rough because anytime you hear something at the window, you'll think somebody's coming for it.
Yeah.
So once banks get this kind of cash, what they then do is that they don't hold on to all of it. The underlying kind of assumption with fractional banking is that none of the people, or rather not all the people who've put their money into the bank will ever want it back at the same time. So if I work out my ratios, I realize that of the 10 billion shillings I've collected this year, only about 1 billion shillings of it is money that people are going to want back. So the 9 billion is what they now lend back to us. And I've seen the base rates are at 17.5%. So you put your money into the bank for free, but borrow it back at 17.5%, and they get to keep that spread.
So they're virtually creating, because someone else comes in and wants a loan, they use your money to offset that.
Yeah, they lend it out to them.
Lend it out at high interest rates.
Exactly.
So they're basically getting money back from nothing.
I remember one of the like when I started to study the financial services space, one of the things I came across was this Wall Street kind of diss on like local banks. They called it the 363 banking,
okay, which
is taking deposits at 3%, lend them out at 6%, get on the golf course by 3 p.m. Like that's purely, that's what banks do. So get money for free, lend it out at a cost. But of course, this cost has certain risks affiliated to it because if you don't pay it back, they still do the deposit of the cash. And that's where now things like pricing of risk, interest rates now
come into place.
Yes.
So let's look at it from a complete beginners, because I'm not privy to the investment world, right?
Yeah.
Let's say you want to work with me today.
Yeah.
How do we sort of approach that when you first meet me?
So with what we do, we actually try and take you and map out a path to the point at which you'll be able to retire. And not retire in the sense of how it's been designed traditionally, but retire in the fact that you now no longer have to work for money. You can still work, but you're not doing it for the money. You could do it for charity, you could do other things, but your primary decision on what you spend your creative capabilities and what you expend your energy on is not how you're going to make money back. And that's usually the objective of what we're trying to do. So we follow a series of steps, right? The first thing I'd want to know is where you're at. Like, what do you own? What do you make? Where does it go? So what you own is essentially everything that you've acquired that's in your name, whether it's an asset of some nature, whether it's an appreciating asset, depreciating assets, or a depreciating asset like a car that's getting cheaper and cheaper. So you're losing value as time goes on. An appreciating asset might be something like land that's increasing in value. So we get a picture of what you own and then what you owe. So what money you've borrowed from different places, credit card, SACCO, whatever it is. And we net that off to get what the net position is. And so what you own and what you owe is the sum total of your decisions in life up until that point. Financial decisions. So whatever what choices you made landed you something. Other choices you made got you into debt. But the net result is what you own, what you owe is pretty much the starting point. And that's the end of the past. It's the beginning of the future. It's where we are today.
So it gives you a very good, again, psychological look at your customers. Because
Exactly.
people have very different spending habits, right?
Before we even get into spending habits, just getting the sum total of what you own, what you owe is usually one of the most, in some cases, exciting and exhilarating thing, but also very depressing for people, because when they realize that they owe more money than the things that they've actually used to, you took a car loan and you owe more on the loan than the actual value of the car, it can get depressing because, you realize that you don't actually own anything. You're basically working to pay off your loans and everything. So
And which is the cycle of life for a lot of people, is you're doing this 9 to 5 rat race to pay off bills, and ultimately the bills just pile up, right?
yeah.
I mean, it goes from car loans to car loans for a place, mortgage, school fees, all this.
Life is expense management. All of life is expense management. All
Right.
of it. So somebody, when you were a kid, your parents were managing your expenses for you. When you become an adult, you manage your own expenses. When you get kids, you manage the expenses for them. When you get older, they probably manage the expenses for you. Or,
Correct.
whichever the case is, the thing about the way the world is set up today, it costs money to exist.
Pure and simple.
Pure and simple.
I come to you and I tell you, look, Macharia, I want to go from here to having private jets, Rolexes, all this and that.
Yeah.
Would you tell me that's feasible?
It is. It all is. And what it comes back down to is kind of to walk you quickly through the process. So once we've got your initial position, we now look at what you make, where it goes. So essentially what comes in, what it's spent on, and what's left over. Because what's left over is what goes into the future. Whatever you spend is gone,
Okay.
right? Your expenses are out, so that's gone out. So whatever savings, insurance that you have that carries value into the future is actually now what you can use to create your future. And so once we have that, we have an idea of what it is, we actually now sit down and decide, what is this future that you want to create? You've talked about Rolexes, you've talked about all these kinds of things. So we have a process of now creating this future. The first step would be, do you have enough money to take care of you for 3 months if anything happened? Right. An emergency.
For rainy day fund.
Yeah. Rainy day fund.
No.
Emergency fund. So that now would be the first thing we'd be thinking about before we get to the
Yeah.
Rolexes, right? Because you want to
Okay.
make sure that you've got this money in place.
So you ultimately clean up basic principles in place.
Exactly.
I've heard there's several sayings around regarding in terms of investing the cash that you have. So let's say if you have 100,000 bob today, they say you should keep 30% for savings. Do you sort of have a rule of thumb in which, as a general rule of thumb, someone comes and says, I have 100,000 bob. How should I structure my expenses versus my saving versus my investment portfolio? Do you have a rough percentage that you look at, or does it vary customer to customer?
It varies client to client. Because one of the things that you begin to understand is that the relationship that people have with money tends to be very, very personal. So 2 people making exactly the same amount of money will spend it very differently. 2 guys, same job, 2 ladies, same job, a lady and 2 very different people. And a lot of these things, the differences usually come from the way that we think about money. Now, there are certain people for whom spending money is a pain. Like they don't want.
Oh yeah,
they
I've
don't
met
want to
those
spend
guys.
money. I'm also one of those guys because
Really?
yeah. I mean, for me, something like upgrading. Like I've driven the same thing for 15 years, man. Like I've just never had a need to upgrade the car. I don't really care what people think about the car I drive. What I wanted is a car, right? Which gets me from place to place. It's cheaper. It's easy to maintain. So I end up buying whatever other cars I buy. I end up buying project cars that are about making me happy, not the way I look driving these things. Secondly, there's a different kind of group of people who actually now use money as coping mechanisms for whatever stress they're going through.
Emotional spending.
Yeah, emotional spending. You'll find, financial infidelity in married couples where somebody's hiding stuff because they don't really want to share. You'll find psychological conditions such as compulsive under-earning, which is actually, an addiction of some nature.
What is that exactly?
So people who could make more money are unable to bill as much as they could. Right. And you might see, and it happens a lot. This is why you hear about A students working for C students, because A students overthink everything. And so end up not, I don't know all the answers to the questions. So I'm not going to bill as much as I could because I feel like I'm not, prepared to give the correct answer. There are certain elements of that's fear of failure, right? What if it doesn't work out? Fear of success, because success means becoming visible, and becoming visible then means you're a target for criticism.
So it ties in very well to personality types.
It does. It
reiterates, because if you're a very isolated person and an individual that does not want to be in the public eye, and you are a brilliant person, you may choose a career path and an investment path that suits your personality versus a class clown, a C-grade student, who basically wants to be in the limelight. So again,
exactly, right?
Okay, so you sit and you actually look at the personality and try and understand.
So what we actually do is, the first stage of this is to get the numbers out of your head, to clarify the numbers. Because if you ask most people, like if I asked you right now, what exact amount of money, if I could pull it out of my pocket and give it to you, would ensure that you never had to work for money again? Right. Do you know what that amount is?
On a personal level?
Yeah.
Okay, let's see. If we're to be realistic and looking at it from a perspective of my personality, where I want to travel the world, I want to have multiple homes, I want to make sure my family is extremely comfortable, the people around me are taken care of. All that taken into account, being a global citizen, I would say if I had... Okay, there are two aspects of it, right? There's one aspect where I was like, you know what, let's have $25 million in a fixed deposit.
Yeah.
That can take care of everything for the rest of your life. You don't need to worry. Realistically, getting from there, from this point where I am right now to there, might be a tall order. So if we're looking at a salary-based person, if you were to do something between, and again, I know people are going to flaunt me for this, but if you look at global companies and what they pay, they do anywhere between $300,000 to $600,000 a year, right? If you can achieve that level of success, that's a very comfortable life living in Kenya, extremely comfortable.
I mean, only 383,000 Kenyans make 100,000 bob and above, according to KNBS, on a monthly basis. So $600,000 is what, $50,000 a month, which is roughly 7.5 million. You'd be in the 0.001% of.
And is that wrong for someone like me to want to achieve that?
No, it's not.
Because here's the thing, a lot of the times that I have this conversation with my parents, with people, my bosses, folks who are much more seasoned than I am in whatever they're doing, they're like, you should be humble, you should have less expectations, the chances of people succeeding to that level are very rare. Like, I need that aspiration. I need to be wanting to have that. I want the millions of dollars, right? I want to be in that position where wealth is not something I would consider. If I want something, I want to get it. Is that wrong of me to feel that way?
Two aspects. The first is, no, it's not. Because unless it's limited by, the laws of physics, what prevents you from making that kind of money? There are people who are making that kind of money, right?
So personality-wise, I'll tell you this, right? If I see someone driving a fancy car, there are two ways I look at it. I'll say, mashallah, happy for him.
Yes.
Secondly, I'm like, how do I get to do that?
Yes.
Right? And that's sort of what bothers me and itches me and drives me to a point where, if we look at our family, right? Families have gone up and down in terms of wealth structure through the diverse political governance structures we've had. There have been tough times, good times. It's up and down, right? You want to sort of get beyond that. You don't want an aspect where financial obligations weigh you down. You want that independence.
Yes.
But then society tells you, no, you need to do your 9 to 5. You need to be humble. You need to get married, have kids, put them in school. I don't want that, right?
Yeah.
And again, maybe it's more of a psychology lesson between us and you're getting a deeper understanding into me.
So there's a very interesting psychological phenomenon that happens. The bigger your goal, you get the rush and the joy of it from setting a big goal, not from actually chasing it. Like, most of your dopamine tends to come with anticipation than the actual work of doing this. But the way we look at it is there's nothing that's actually stopping you from doing that. What we now need to do is to clarify what are the actual numbers. And we sit down, like you said, you want private jets, this, that. We get the pricing for this. And we figure out how much is it that you're actually going to need in capital, how much is it going to be invested at a return rate. Like you say, 25 million in some fixed income, paying you 12% gives you a certain cash flow every year. So what we then do is we sit down and we look at all these goals that you have. And that process is usually a very interesting process because there are different kinds of thinkers from what we've learned. There are past-based thinkers who say, this is how far I have managed to get to. So they're doing past plus 10%,
Right.
past plus 50%. I'd like to get to, double of where I am.
Yeah.
And then there's the, kind of people who are trying to get to a really big number, right? Which if you ask them what their plan is, they don't really have one. They just enjoy having this really big number in their head. So we take that number, we try and break it down into its constituent parts, right? You said multiple homes. Where are these homes? Where are they based? How much are they worth, right? So rather than just having this idea of multiple homes,
Right.
we actually
sort of need to
dig
look
in.
at.
You say private jets.
Yeah.
Do you own it? Do you rent it? Do you book it when you need it? Do you what's the whole thing that you're thinking about, right?
Yeah,
in that space.
Never buy anything, lease it, right?
Yeah, exactly. But leasing is but from what I've seen, because you could be talking about $30,000.
For sure. You see, the thing is, there is the delusion of grandeur. There is the
Exactly.
delusion of watching all these movies, seeing the Wolf of Wall Street lifestyle. Some
Yeah.
people are very attracted to that versus other people who don't, and I completely respect that. And in fact, Mo Devji, the Tanzanian fellow, there was a video of him. He did a podcast recently, and he said that, look, you have to understand that in Africa, the problem is the spending power of the person is so
low
that you can't do one thing and then succeed in that business because there's no purchasing power related to that individual. Versus if you look at the American economies, the first world economies, where you can do one business like SpaceX and it goes to the sky.
Exactly.
And so in his sort of bracket, he's in manufacturing. So if he's manufacturing oils, he goes into then the production of oil, he goes into the manufacturing of the jerry cans, and then he ties that to the paperwork that goes into it. So he opens a branding business specifically for that. So he's building up on his business vertically and also horizontally.
Yeah.
And again, I do understand that in order to achieve that level of success, given the financial position we're in, you have to have a very diverse portfolio, right?
True.
Not just in terms of investing in terms of stocks, but businesses. So
your income sources.
Is that something then you would guide me and work on?
So what happens is once we've established the pricing of all these things that you're looking at, and sometimes people begin, once you start to drill into it, people begin to realize that they've just held onto an image that they've never clarified. Because it's given them a sense of, and this is one of the psychological things that we see when I was talking about the psychology of money and the relationships with money, is that people actually do enjoy thinking about getting saved one day. Like it takes you from being responsible.
Getting saved meaning through some happenstance.
An uncle of yours passes away and leaves you $1 billion shillings. Like those kinds of fantasies. And you'll find, particularly a lot of times, like right now, I'll have conversations with people and I'll ask them, do you ever wish you could stop time just so that you can organize stuff? Like put everything on pause, just, sit down, do your bank statements, figure out where your money went, figure out where you're trying to take everything. Like this desire to stop time, because life just keeps hitting us with stuff every single day that never seems to end. Every time you think you've gotten out of the race, you're suddenly in a new race. And I remember one of my advisors, who was a fast board chair at Abacus, once told me that your problems don't change. It's the numbers that do. Right? You're still trying to get fed. You're still trying to get housed. So 10,000 versus 100,000. You're driving a Vitz versus a Prado. The problems are pretty much the same. It's just the numbers on these problems that don't change.
Now that you say that, that's actually so true, because looking at my history, so the first job I ever got, I was making 20,000 bob a month, which for an intern is sort of the given rate with the university you go to. Then the job I am currently in right now, I started off at about 80,000 bob. And at the time, I had just done my master's. I felt 80,000 bob as a 21, 22-year-old. That's
pretty decent.
Pretty decent, not bad.
And you're still at home probably at that point.
Exactly. Yeah. So everything is taken care of. And one person told me is the same thing you said, is that the more money you get, if the money makes you change your lifestyle,
you're trapped.
You're trapped. And what ended up happening is you can go from 80 to 150 to 300 to 500 to 700 a month. And your lifestyle changes, because all of a sudden you've gone from a Honda Fit to now.
Yeah, exactly.
Then you
You
go
know.
to
A C-class Mercedes.
the antique Harrier.
Oh, yeah.
And then you go to a Prado.
Actually, what happens is you go the transition from like a small Toyo to a bigger Toyo, then to a German, then to a bigger German, then into the 4x4s.
Exactly.
Right? Like that tends to be how people will kind of.
Correct.
So by the time you're hitting your 40s, your kids are getting bigger. So you're convincing yourself you need a 4x4, which, by the way, you use to go to the mall. You never really go anywhere. It never goes off tarmac, right?
Exactly. Then you go from Buru sides. You live
exactly.
in Westie.
So
you
you
rent
want to
cars.
cross the Moi Avenue, like the Uru Highway, right?
The Uru Highway expense line.
Yes, the Uru Highway expense line.
As soon as you go above there, everything starts
goes
becoming
up,
more
right?
expensive.
It becomes really expensive.
Your locals even changed now. The
Exactly,
language,
right?
the drinks you have. So
Yeah.
ultimately, I guess that is also a psychological aspect. And I understand that if your lifestyle hadn't changed, you could make more smarter decisions. And maybe that ties into the second question I had, which the misconceptions maybe folks have when it comes to investing, saving money, scaling their money. What are some of those misconceptions?
That you don't have enough to start with.
That's a good one.
That's always the biggest problem that we see. Everybody, and it's across the board, from somebody who's making 10,000 shillings, so genuinely this person doesn't have enough, to somebody who's making a mic a month and says, I don't have enough, right? I don't have enough to start investing. Yeah, because like you say, lifestyle creep. So you suddenly want to drive the Range Rover, right? Because with that new salary and your position, and it's weird, and it's there's a huge chunk of the way the world works nowadays that's about how you look more than who you are, right?
Correct.
And a friend of
Social
mine,
media phenomenon.
yeah, actually even above social media, a friend of mine came in from Canada working as a financial advisor, got a job locally, and in places, in more advanced markets, in certain places, places like Canada and Germany, for instance, people who are very prudent with their finances, your financial advisor should never look like they're spending your cash. So you can't be driving the expensive car.
By the way, that's true. If I saw my financial advisor, if I start investing with him, the next time he's driving a better car and all, you start questioning.
Some people actually get impressed by it because they
two
think
ways.
you're doing the right thing, so you must be making money. So he gets back in and he shows up to work with the cheap Toyo he bought and his cheap brown suits that he just looks like like a low level accountant, but he's a senior official at this business. And HR comes to him and says, what's wrong with you? Why are you dressed like this? He actually had to change because in this market, in the wealth management space, you actually need to look like you're wealthy.
Correct.
Right? Because then people believe that you know what you're doing.
It's a cultural aspect. If you were a wealth management persona or you're running a firm in Dubai.
Exactly.
Yeah.
Right?
Versus, let's say you're in Rwanda, Kigali.
Exactly.
Where money is seen as a very different concept, right?
In places like that, you don't actually want to be
seen as very flashy.
Yes, very flashy, right?
You want to be the respectable monochrome glass.
Exactly.
Tied up. Yeah.
It's tied up, cheap Toyo that's well maintained and everything.
Yeah, this guy won't play with my money.
Exactly.
Yeah.
So people actually see that you have restraint. So you don't actually try and take all their cash. But on the flip side is there's the illusion of success that actually now builds success.
Okay.
Right? So if you pull up in a BMW and I pull up in my cheap Toyo and we're bidding for the same thing, you're most likely going to get it because it looks like you know what you're doing, even though I might be better at what I'm doing than you are.
So I work in sales, yeah?
Yeah.
Now, there were a lot of aspects when I initially started that I learned, and it was very hard to accept because whenever I would go on sales tours, I was disregarded.
Yeah.
And so my boss told me two things. Look at how you dress and look at how you look.
Yeah.
Right? Look at how you dress, look at how you look, because people perceive you a certain way. And what I noticed is I was clean shaved and I wasn't wearing the most expensive suits.
Yep.
And my boss, bless him, he bought me my first suit.
Mm.
Right? Really nice. In fact, I'll post that picture. We post that picture of it. It was a blue suit and I grew my beard. The attention I was getting now was very different.
Yes.
That's one aspect. As years passed by, I went from driving a Honda Fit to then eventually going up to a 4x4. I won't say which car, but it's a very dominant car.
Yeah.
The perception of everyone when I came for the meeting
Change.
in that 4x4, the Askaris were like this. I'd never experienced that in my life.
Yep. Yeah.
When I was in the Honda Fit, I was like, Chokora, weka huko gari.
Yeah.
When I came in that 4x4, The guy stands straight. He's sort of giving me a salute. Just the person at the restaurant, from the askari to the waiter to the client meeting me, the perception changed because of that car that I had driven. And it was something that I was like, Jesus Christ. Is that really what happens in Kenya? Is that why so many people...
No, it's not just in Kenya. It's everywhere.
It's everywhere.
It's everywhere, man.
To be fair.
It's everywhere, right?
Right. So, I mean, you guys, maybe in Kenya, what we
Optics,
need to do is, it changes the perception of how you meet someone. And I understand that it can be taken two ways, right? Because someone can be looking the part, but in actuality doesn't deliver.
Doesn't deliver.
There's a
and
fine
that's what
line.
ends up happening a lot.
Touching base on what you said, it doesn't matter how much money you have, right? You can start with 10,000 bob, you can scale it to a mic. What are, again, I know it's your business, but what are some surface level strategies I can implement and people listening and watching and can implement starting today if they want to sort of achieve financial goals? What are some tips you can give folks?
I tell guys, focus on the process, not the outcomes.
Okay.
Right. The journey to financial freedom, the journey to a place of financial liberation, and maybe just to work backwards. So when I talk about financial wellness, the kind of financial wellness that we do, there are two key components of what we try to achieve with our clients through our education, advisory, and the products that we build, technology products that we build. And it's a state of being and a state of doing. So financial liberation is one component of it, which means that your identity does not change depending on how much money you have. Your relationship with yourself, the way you see yourself, forget the way you're seen by anybody else, but the way you see yourself isn't related to how much money you have. It's like your self-image doesn't have a fee. So that's financial liberation. The second aspect of it is financial flow. And if you know the concept of flow, when you're working on something and you disappear into it for like 3 or 4 hours.
Flow state, yeah.
Like exactly. Everything's working out. The challenge is good enough to keep your mind engaged, but it's also enjoyable. So what we look at with financial flow is a state of dealing with the things that you need to deal with without them actually being problematic to you. So I'll give you an example. Very, very, very simple task or very simple thing. Do you ask for your balance after you do an ATM withdrawal? That's that. Do you ask for your balance after an ATM withdrawal?
I don't.
You don't.
Yeah.
Why is that? Because you're afraid of the number that you're going to see is going to be low.
So okay, it depends, right? At the start of the month, when I know the commissions are coming, when it gets to 15th, that's when I start checking the balance, right?
Yeah, exactly. It
depends again.
So you actually do the inverse, right? For you at the beginning, when you know you have money, you don't actually check the balance. It's when you get towards not having money that you begin to get a little bit more aware.
So again, to answer your question, let's say, because I work in sales,
you're
rewarded based on your effort.
Yes.
Right? And I know if I put in the effort, I know the money that comes in.
Yeah.
And so once we close that deal, I'm like, okay, fine, I'm set. I can do this.
Yeah.
It's now once the money comes in and then
you've spent it.
You spent it there, done things, put it in here, put it in there, gone on. You run in Kileleshwa, Lavington sites and doing all those stuff.
Yeah.
Then I start becoming financially aware. Yes. I do have a safety net.
Yes.
In fact, one of the things I started doing was I started putting all my money in dollar.
Okay.
Any excess money I had,
I
just opened a dollar account, because what ended up happening was over time since 2016, when the dollar rate was sub 100 shillings.
Yes.
110, 120, 130, 140, 160. Yeah. So when it reached the 160 state and I looked at my assets, I had actually appreciated a lot more than I had expected.
Yeah.
And if you look at it this way, if you have 100,000 bob today, right?
Yep.
That 100,000 bob stays in a fixed deposit. How much do you get?
Depends if...
roughly,
12%.
12%. Let's say 12%, right?
Which makes it easier for math. Yeah.
So you
get 12K.
At the end of it, you get maybe 110 on top of what you're in. So 10,000 on top of your initial investment. If you had put that money in dollars, let's take in case last year, it went from 120 to 160.
Yes.
Your money is already appreciated in excess by 40, 50% to that point, in addition to whatever you're getting at the bank. Right, so that's one thing.
Let me give you now the flip side of it. Somebody who got in at 160 and then it dropped to 130. Now has gone has
Correct.
had the flip side.
Correct.
So that's why I was talking about actually creating portfolios, because then we divide these things by risk.
Correct.
Right. So you don't necessarily put all your money into dollars because you know you're going to get 50% on top of it, and then that 50% is what is going to pay school fees and stuff like that. What we do is we graduate the risk, and how we pick your investments is based on what you're trying to achieve. So you remember when we talked about all these goals that you've got, and then the money that you're making and the money that you have available. So the money that you have available is what now we will determine based on the goals that you have. Where should we actually be investing this money in?
Correct.
So, for instance, something like your emergency fund, your kind of rainy day fund, you don't want to put that into crypto because the day you might need it, crypto might be down 60%.
You're talking about crypto. There's some guys seated over here.
Yeah.
Every single month he gets money, he's pumping it into NFTs and this and that.
And for some people that works.
Yeah.
For some people that actually worked out really well. I mean, we've seen people, I've worked with a lot of clients over the last maybe 6-7 years who made a bunch of money from buying land, right? When land was still like really, really cheap before it started skyrocketing. And of course, after Kibaki took over, we initially had the 2000 so he took over in what, 03, so 04, 05, 06, and 07. The hottest investment was the Nairobi Securities Exchange. Like you couldn't go wrong with this thing. I was running a high yield fund, investing money in people on behalf of people, paying out 20-25%, just picking any stock on the Nairobi Securities
And it
Exchange.
grows.
And it just grows. Because what had happened was after 30 years of like economic suppression, suddenly everybody's quite interested. And the simplest place for people to actually get their investments into the market is through the capital markets themselves.
Right.
So going straight into buying Safaricom, going straight into buying. So that's how people actually, so foreigners who are looking to drive that return, that was the simplest way for them to get in. And so that, kind of shot up how the market performed. 2007, post-election violence, 2008, early on, slowed down the market because now everybody got scared. And I remember I was heavily invested and I owed a lot of people money because I was managing this fund. And I'm trying to exit, man, and I'm getting 60 cents to the dollar. I'm getting 60% of whatever my investments were because everybody's now trying to exit because they're afraid Kenya's going down the civil war route as a lot of other countries in Africa have. So they panicked. And to make it even worse is that maybe 4 or 5 months later, July of 2008, Safaricom did their IPO. And the Safaricom IPO was supposed to be the thing that now blew back the Nairobi Securities Exchange into what it was. Man, that IPO was a clusterfuck. Like, it decimated that market. Because first and foremost, the amount of demand that was there for Safaricom was insane. And especially since everybody had, kind of missed out on the Kenyan IPOs and, all of these others that we'd had a really good time doing. But secondly, a huge chunk of the investment in Safaricom was on credit.
Really?
Banks were lending. I mean, you walked into Equity Bank.
Yes, I remember. There was that period, exactly.
Yeah, exactly. So banks were lending this money, even to people who'd previously not have managed to buy it. You go in to do your deposits and whatnot, they're convincing you to get into the Safaricom IPO, they're going to lend you the money. Even people who aren't interested. So the amount of demand that it created and the amount of retail interest it created caused a massive issue with the processing of refunds and the actual issuance of shares. And so that now ended up killing the NSE because since then, I mean, Safaricom IPO'd at 5 bob, went to 2 bob and sat there for years, right? And, the market was dead.
Okay.
So some of these things are what I say you need to be aware of the kind of risk that you're taking. And so the way we look at it is as you go through life, there are certain levels of obligations that you have. Can we lock those down as taken care of at a certain level before we start taking risks for the next level?
Okay.
Because you don't want to take one risk, put all your cash in crypto, go from having 5 million bob in the bank to owing 7 million shillings, which kind of happens a lot with high-risk investments.
I appreciate the fact that you handhold your clients through the process and just make them quite aware of touch points that they need to be privy to, right? If you'll allow me, I wanted to circle back to the dollar as a saving strategy in this modern day and age. Do you think it's still feasible? Because I come at it from this perspective. if we look at the valuation of the Kenya shillings, it's not appreciating. It's what's happening is we're losing the value because we're an import-dependent economy. Everything is pegged to the dollar.
Yep.
And currently, whatever we have, a lot of people have speculated that the shilling has strengthened, where nothing has changed economically. I've heard sayings and sweet whispers that it's being manipulated to that extent.
To some extent, yeah.
So ultimately, folks are still telling me, put your money in dollar.
Yep.
Leave it there, because as years go by, when we eventually get to 170 shillings, 200 shillings for $1, you'll be glad that you still had that asset. And as long as globally, fuel is still being traded in the dollar, doesn't matter what the fuck India says, Arab Emirates, China, as long as fuel is still being traded in the dollars, your currency will actually appreciate. So, I mean, I know that was sort of a long story, but,
but
you understand what I'm getting to.
I get where you're...
What would you say about that?
So one of the disadvantages of working in kind of wealth management is for some reason everybody assumes we can see the future. Yeah. Right. like everybody comes and asks me, should I keep my money in? Yeah. I'm like, bro, I don't know what the Federal Reserve is going to do tomorrow.
Correct.
Right?
Yeah.
We've been a lot of, when we do this research, because a lot of the times you're just looking for signals. You're looking for information that's going to help you determine what the direction is going to be. And earlier on, so I'll give you one of the things that was happening with Kenya. So the Euro bond, right? The Euro bond payments that needed to be done, which looked like we wouldn't make it. And we would not have been the first ones because Ethiopia and Ghana were just like, we ain't paying this shit. They just, they were like, Ghana was actually really funny because I was reading about it and they were like, yeah, we've got the money, but like the rest of our creditors, we're just not going to pay you guys either.
Correct.
Right. So join everybody else and we're not paying this. And so people thought Kenya was going to go the same way. Right. But so what that did is that it made Kenya a risky investment. So the Eurobond itself started to get pricier because guys are like, you need to pay us more for taking risk because we might not get paid back our money.
It's a higher risk.
We don't know what's going on. And so that now creates an internal pressure because one of the things that you also need to understand is that macroeconomic movements will have significant impact even on smaller investments. Because once the country looks like it's not going to make its payments, right, countries start to pull out. You remember shortly after or towards the payment of the Eurobond, one of the largest banks in the country offloaded half of its government holdings, right, in the market, and they took massive losses on this. They were just like, we're not holding this anymore. So which of course then tanks the price of bonds, changes a whole lot of things. And then we made the payment on the Eurobond, and then suddenly everybody's like, okay, these guys are still legit. So and they were willing now to invest again because they were like, these guys are willing to.
So it ties into many factors. And
exactly.
It's not something you can accurately predict. You can to a certain extent if you do research, but then again, there's always...
I mean, if I could predict these numbers down to the cent, why would I need to work?
Like if you remember what happened in, 2013?
Yeah.
When Greece was told to sell its assets
to
get a bailout, but then the Federal Reserve then stepped in. And then the gold prices dropped, and then basically gold was taken in, manipulated in the market, and then the prices went up. How do you predict against that?
Honestly can't. So the way I look at these things, and it ties in very, very much with the way I see life. The thing about being human is that we try to create certainty, even in situations where we are trying to be in control. We don't want to actually be afraid all the time because you don't know what's going to happen. And so the way that even the work that we do isn't really based on being able to predict where the future is going to go. It's being able to respond to what happens in the present.
Correct.
Right? Because like you said, I mean, you might have bought the dollar and held on to it. I have a client who went the opposite direction. When she was like, this dollar is now going to 200. She got in, I think, at 165. Then it dropped to 130. And then suddenly she's like, did I make the wrong move? Is it going to go back up? And I'm asking her, what was the whole point of this? Like, what were you trying to do here? Were you just trying to take advantage of that growth, or was there any, did you need those dollars? And she was like, I just had people saying the dollar, so I jumped in. And it ended up wiping her. Like when it dropped back down, it wiped out a
substantial portion. Again, I can understand if you bought it at 160
and then it drops to 130 and suddenly,
and you have 100,000 bob, that's 30,000 bob loss on your investment.
Exactly.
I definitely got hit.
Yeah.
But the thing is, the overarching investment of mine,
Yes, when you actually do what's known as dollar cost averaging.
yeah,
Right.
I was still in the positive.
Exactly.
And I'm still buying dollars
Yep.
with the assumption that the Kenya
We'll
shilling
keep going up.
will keep going up. It will go to shit. There's nothing we can do. Okay, thank you for that. That's actually a lot, given me a lot to think about. But I want to now circle back to a question I have.
Yeah.
In fact, someone asked me to ask you this.
Yes.
I have 100,000 bob today.
Yes.
What should I invest in?
Oh man, that's the most common question I get and one of the hardest to answer, because it depends on what, it depends on what you're trying to do and where you're at. If this 100,000 shillings is probably school fees you need to pay in 6 months, I'm not going to tell you buy crypto, something that I can't predict whichever way it's going to go. I'm going to tell you put it into a money market fund. If it's money that you might need in 20 years, I can tell you, what, find a piece of land somewhere that's likely to develop, because over 20 years, honestly speaking, land is the largest, it has been the best performing asset class consistently over a long time in Kenya.
So let's talk about that.
Yeah.
The two questions I have, right? We'll touch base on the money markets.
Yeah.
I'm not privy to that, but if I were to go about investing in the money markets, how would I go about doing that? And what in particular should I look at?
Okay.
The second question I'll ask you once we sort of get through that, because
Okay.
I want to spend a bit of time on that.
Yeah. So money market investments are short-term kind of debt instruments. So they'll typically be your treasury bills, treasury bonds that are short-term. And the idea is that when you're investing, and you can make investments in two ways. You can actually make the direct investment, which is go buy yourself a stock, a bond, whatever it is, or you can actually make it through a managed investment. So your unit trusts, we've seen CIC, Sanlam, all these guys who have money market funds, they have equity funds. So what these funds are is you're putting your money with somebody whose job it is to go and look out to try and make the best potential return for you. So you're not picking the specific stocks themselves, you're just picking the fund itself, and then it's their job to pick this. So with money market funds, it's the same thing. So what they will do is to take the cash that you've put in and invest in short-term interest-bearing instruments. Some
Different risk variations.
Different risk variations. Ideally also maintaining a cash balance, again, fractional type thinking. And money market funds they're actually very good because, and particularly in places like Kenya where we can actually process all of these things very, very quickly, you can earn up to 16% of this cash. It's accessible to you, can invest anytime you want. It is compounded every month, right? So whatever money you made last month has made money this month and will make money next month. So it compounds over time. And you have access to it for most funds even within 24 hours. So you can get your cash out within 24 hours. Okay. So it's like having a bank account that you deposit money into that's paying you 10, 12% a year that you can get out in
any time
24 to 48 hours.
Fair enough. I've heard about T-bills quite a lot.
Yeah.
What are those specifically?
Okay. So treasuries. So there are two kinds of treasuries. Treasury bills and treasury bonds.
Yeah.
Treasury bills are usually anything that the government borrows from the market for less than a year.
Okay.
Anything more than that will typically be a bond. So what you'll have with treasury bills is you'll have a treasury bill. So there are three in Kenya: the 91-day, the 182-day, and the 364-day. What that means is that you put your money in, you get it back after 91 days with interest. But what the way they price treasury bills is actually slightly different from the way most people think of investments, because when you bid for 100,000. And then you set a certain interest rate that is going to be paid. What they calculate is that interest as a function of the 100,000. Then you pay them the 94K. Then they'll pay you back 100K.
Interesting.
Right. So they take out the interest plus the taxes. You pay that figure. Then they pay you back. So instead of putting in 100K and then they pay you back 116K, you actually pay less to get the face value.
Interesting.
Right.
And I'm assuming the risk associated with that is much less.
91-day T-bill rates across most economies are considered the risk-free rate.
Right.
So it's the benchmark rate for investment return.
It's a good way then to get money in the short term as well, right?
It is, but now what happens with it is with these instruments, short-term instruments, they tend to require a lot of capital.
Yeah,
because you're getting 16%.
You don't pump in 100,000 bob. You're doing.
So if you're doing 12K, I mean, if we're doing, let's say 12%, well, this is not the exact way that it would be calculated, but for ease of understanding, is that with a 91-day T-bill rate at 12%, you get 3 months of 12%. So you end up with, a quarter of the 12, which is about 3%. So if you put in 100K, you made 3K over 3 months. It's still higher than
what you get, but then
what you might get elsewhere.
the scale is now where it matters. If you're putting in hundreds of millions, that's when the difference comes in.
Now that's where And so what happens with investments? There are two stages to actually to building out your financial freedom kind of pool. The first stage is actually capital growth, because most of us will typically, unless you were born with silver spoon and you've got a ton of money that's available to you, for most of us we have to build up a capital base, and then this capital base is what now starts to become the income earning investments. Investments earn money in two primary ways. The first is capital gain, where you put in X amount of money and then it grows to a certain amount, but you don't really make anything in between. So like buying land and then selling it after 10 years, right? So you bought 400,000, you sold it for $1 million, but in between there, you didn't really make any kind of cash. On the other end of it, the extreme end is where you generate cash on a monthly basis or a certain frequency, but the price of your investment doesn't change. So like if you buy a bond and hold it to maturity, you put in 50K, you'll get back 50K. If that's 20 years later, you'll still get back that 50K. But every 6 months, you'll have received some cash. And then somewhere in the middle, we have hybrid, things that actually yield some cash flow. Get capital gains and yield some cash flow. So like real estate, residential real estate, it's appreciating in price, but it's giving you cash on a monthly basis. So what happens with the extreme end of this fixed income, like where you're going to get this fixed return, is that they tend to be very low in terms of what it can yield. Because I'm guaranteeing you this cash, I'm making sure you're going to get this money. So I make it very low.
Correct, yeah.
On the other end, now we have the opportunities for massive growth. So like what you're doing with the dollar, you're putting in $100 or 100,000 shillings worth of dollars to get back 120,000 shillings. So that capital gains. Now, if you don't have a clear picture of what it is that you're trying to achieve in your life, right, you then get obsessed with maximizing the amount of cash that you can get because it's the only game you know, rather than actually saying, because one of the things that we do is every 6 months, every 1 year, do a portfolio review. And you might find your speculation portfolio has gone 20, 30 times, whatever it was before, 10 times. And for most of us, we want to keep growing that. What we usually propose is at the end of the year, lock in what you have.
Right.
Bring it out, pay off some debt, or some, continue building up your levels of assured assets over time rather than speculative. Because we've seen you can be worth $1 billion today and
then
nothing
it drops off.
Yeah.
So very
FX.
cautious, managed approach where you're building year on year on your investments to eventually get to a place where
exactly.
your money's working for you.
It's working for you. And money working for you doesn't necessarily mean that it's not actually going to have the opportunity to do this risk investments. Actually, it's better because then if you're making, like you say, to Mike every month and you can spend all of it putting it into crypto, if it goes to hell, next month you've got some more cash.
Fair enough.
Yeah.
Now in Kenya, a certain trend that I was introduced to by my fellow Kikuyu counterparts, Nekemodo.
Broti maguta.
So eventually I was introduced to this concept and I need your input on it. Ploti.
Broti maguta.
So what is the appeal to buying land? Let's in Kenya. Talk to me about that phenomenon.
So I've come across so many different theories as to the reason why. One of the most interesting ones, I think, that I came across was based on the psychological effect of colonialism. And you notice that it tends to be people from central Kenya who are known for wanting to own land like crazy, right? Like they're obsessed about it. And in a conversation with a couple of psychologists, about it, because I do spend a lot of time speaking to psychologists about the kind of situations that we are looking at so that they can help me get to understand. One of them pointed out to me that central Kenya was actually the place where a lot of people were kind of displaced from their lands and put into concentration camps, right? So when the white man left, they wanted the land back. And so there's this obsession of you should own land. Because we didn't have it. It was taken from us. And this was made worse by the political elites who at the time then used it to continue that sense of taking from. So this land now belonged to all these people in the villages. There's actually a book I just recently read. It's called A Tale in the Mouth by a Kenyan writer who's giving, I don't know whether it's a fictional or whatever story. He's talking about how these guys went to become Mau Mau and then came back and found that the land that belonged to them before they
Was
became
taken.
Umau was now the chief's land, like it had been taken. And so that increasingly created a sense of alienation. And so people end up now feeling like I have to own a piece of this country that had been taken from me. And it can be what's known as, generational trauma, psychological trauma that carries through kind of entire communities. Because
So it's very prevalent in the Kikuyu culture.
it is actually, like, a lot of people call it Kikuyu wealthy, where you'll find people with billions of shillings worth of land, but no cash flow. No cash flow.
I've known this. I've known folks who every month they'll put money into land, however, will wear the same
Exactly.
shirt
Yeah.
3 times a week. They're okay with it. They have no cash flow at all.
Now it starts to get tricky when they no longer have cash flows coming in, because now at retirement they need to start offloading these things, and that's why you find that what ends up happening is that the next generation just offloads all of this stuff.
Correct. So is it a good idea in 2024 to invest in land around Kenya?
It still remains a good idea. To quote one of my favorite writers, Douglas Adams, buy land. They're not making any more of it, right?
I like that.
like there's. So it's always a very.
So I'm going to Nyandarua. I'm buying plots of land,
But again, remember, you're looking at risk aspects of it,
which is again,
Yeah.
land in Kenya. The risk factor is just phenomenal.
So
you
the
can buy land today, and then you have two
Exactly.
people coming in telling you, you know what,
Exactly.
we also own this land.
So there's so many levels of risk, because most people actually just consider risk from a financial perspective, right?
Yeah.
Like, am I going to make this money or not? Now, on that perspective, it's kind of difficult to lose value on land in Kenya, especially undeveloped land.
Yeah.
We've actually seen a situation where one of our clients was trying to sell a building they'd done about 25 years ago, and they couldn't sell it. And they decided to tear it down and sell the land. They tore it down and sold the land for twice as much as they were willing to sell the building for,
Whoa.
right? And there's that desire for people, because you don't know what's going to happen in this place, so you kind of want to just take advantage of that is going to it's going to become something big later on. You can add it to your speculation portfolio. Some of my clients, I mean, one of the best strategies I remember coming across is a gentleman who bought pieces of land of the same value every time he got a kid, with the intention of selling that land with one thing as its purpose: paying university fees. So he was willing to hold for 20, 25 years, right?
You have to have that appetite then.
Exactly,
Patience.
right?
Again,
Yeah.
if you're not... Okay, so there is an appeal. There is a risk factor. And again,
So the risk factor is not necessarily the financial risk factor, because with risks, you've got multiple things. You've got liquidity risk. So liquidity risk means you've tied up so much of your money in immovable assets. So the day you need to pay a hospital bill for someone,
how
you've
do you
got
offload it?
nothing.
Yeah, immediately.
So you can't get that liquidity
Correct.
immediately. You've got cash flow risk, which means that in the case that you're looking to actually make some kind of cash from other ventures, renting it out, leasing it out, whatever it is, that might actually not happen. You've got political risk, right? You've even got tribal risk in places like in Kenya, which is the weirdest thing, that certain people don't want other people from different tribes to live in that space. So that kind of social risk. So there's quite a lot of it that goes into land. Speaking for myself, I'm not really big on physical assets.
Okay.
I'm huge on financial assets, but primarily comes from a very different spiritual perspective from the way I say things. I don't really have an attachment to material things.
Interesting.
Right. So I find myself more interested in investments that are actually going to generate cash flow, because then I can use that to do other stuff and help people, right? Predominantly, I actually want to spend a lot of my time and my money just kind of, I've got a lot of privilege, connections, gifts, whatever it is. Can I use this to act in service of people who don't actually have access to these kinds of things? Can I use my knowledge of finance to take people out of the holes they're in and actually get them set up in a way that they can then do something else for someone else without necessarily thinking about money? And that's actually what drives me when it comes to doing this kind of work.
Sure.
Yeah.
A question I had related, we've spoken a lot about the Kenyan ecosystem in terms of investing, right? I mean, is there any key considerations to international listeners and people who are watching this that they should be aware of when investing, let's say in Kenya? Is there something that you tell them that's very different from developed countries?
Due
Because
diligence.
I mean, you touched on tribalism as well.
Yeah.
I mean, there's a lot of stuff that people are not very familiar with.
Exactly. One of the things that you need to do is due diligence. To be honest,
And do you help with that?
well, the lawyers are pretty much there. I'm not going to be doing searches for land and whatnot.
Yeah.
And even those still don't prove anything, because you'll find a title that's 8 owners in being declared as illegal because it was stolen back in the 90s, right? There's a lot of kind of due diligence that needs to go into this.
A tip I was told is never buy government property, because you just never sure.
You're never sure who. Yeah. But the thing about it is, you might not be buying government property, but you're buying property from somebody who stole government property.
Correct.
Right. So 3 layers in, you have.
It's just too much risk associated with
exactly.
it. So, I mean, due diligence, again, just have your wits about you.
Due diligence, and then there's delayed gratification is something that a lot of people are struggling with right now. People are not willing to wait to see things grow. People are not willing to work for longer periods, because one aspect of it is it doesn't work. We've studied all this, we've taken all these degrees. Remember that song that used to play on KBC? So many vijana mwisho wa kusoma, utapata kazi nzuri sana. Study, at the end of studying, you're going to get really good work. Doesn't work.
I mean,
Kenya has one of the most educated and employed.
I will say this. In fact, I was recently in a meeting with an international company that's looking to set up assets and bases over here, and they were blown away by the caliber and quality of the Kenyan workforce.
Exactly.
They were literally telling, because they have assets all across Africa, and he was very clear that if he were to hire anyone from all the African countries, he would pick a Kenyan first.
Yes.
And I was so proud of that fact, that it's true. If you go around and looking at the people we work with, I mean, even the tech sphere, that's why we're considered the Silicon Savannah.
Exactly.
Our level of literacy, understanding, hospitality.
Travel across Africa, and you walk in and you see a manager with his Maura, and I'm like, hey, you know where I'm from? That name is very common. And he's like, where are you from? I'm from Kenya. He's like, oh, Mudo Muranga. And suddenly you're like, okay, this is, Namibia, Nigeria. I'm just bumping into Kenyans.
The Kenyan workforce is one of the best assets you can have when starting up a company in Africa.
Yeah.
A question someone had asked me to ask you just before we started is, and I'm not sure if it's under your docket, so you cannot answer. How do I phrase this? We had a question come in, and I'm not sure how to phrase this. I want to phrase it very carefully so it doesn't seem, you never know who from the Gava is watching over here. Tax minimization, right? How
do you minimize what goes out?
Yes, how do you pay less tax? What are some of the tips and tactics folks can...
Paying less taxes?
To pay less taxes. Okay,
so for instance, as an entrepreneur, one of the things I'll tell you is incorporate your business, right? Make sure that it's a business, it's an entity separate from the person, because sole proprietorships will end up having to pay taxes on income, because the separation of whatever came to you as an individual versus what was business expenses might not be as clear. So as a business person, when you're doing business under a company, you're actually allowed to expend certain things. The fuel you spend to get from meeting to meeting, even the car that you drive. Of course, the taxman will look at that as a benefit as well, but you minimize your taxes through business kind of structures that allow you to pay out less taxes.
Yeah.
Now, when it comes to personal income tax on things like employment and employment taxes and whatnot, there are, and though the government's been cutting all of these things out, man, things like personal relief and whatnot, which to be honest is really, really crappy strategy to try and raise revenue, because you can't take from people who already don't have enough money, so businesses are not hiring anymore. But with individual personal income taxes, there are certain things that are called reliefs and waivers. Well, waivers are usually when you haven't paid. So with certain things, like if you've got a mortgage, right, you need to register that with your employer, because there's a certain tax benefit. So that when your employer is calculating your taxable income, they actually take out your mortgage payments. But it has to be on an owner-occupied first house, right? Owner-occupier mortgage. So you can't have it for your rentals and then deduct it from it has to be for the house that you live in. If you've got life insurance that you're paying for, if you've got an education policy that you're paying for.
Yeah.
This doesn't mean that you don't pay taxes on these things. What it does is that it minimizes the tax bracket. It lowers your tax bracket to a lower range, right? So if you're paying up to 24,000, and I need to update because I think they've just been changing these things over the last few months, and I haven't kept up quite as much as I'd like to. But things like your mortgage, life insurance, there's certain things like
Life insurance, huh?
yeah. So medical insurance will be taken care of by your employer. I'm not really sure whether you can deduct medical insurance, but there are certain provisions within now the tax law that if you're paying for these things,
That they can.
yeah. So even your retirement, things like registered pension funds.
Okay.
If you're actually saving in a home ownership if you don't have a home but you're saving for one, and you're saving for one in a registered what's known as home ownership savings plan, which are provided, let's say, by Housing Finance, and I know Saiton has one. Those savings that you put in there up to a certain amount can actually reduce.
Okay, so the tips and tactics that you can guide.
Yes.
One phenomenon, especially now, if you'll allow me to speak freely,
Yeah, please. I thought you've been speaking freely all along.
wash money.
Yes.
Of late, I've noticed a lot of salons opened up, which are completely empty. Lots of clothing stores, cinemas, this and that. And in fact, we probably have one of the most successful salons in East and Central Africa through putting millions of dollars. Yeah. Those kind of things, those kind of aspects, it's very prevalent today, right? And is it a cultural? I mean, I'm sure it's happening globally as well, right?
I mean, wash. Kenya's economy.
Wash is actually coined in Kenya. You know what I mean? A lot of people do that. It's something that.
That's known. So, and again, it's gotten us into trouble. We were put on the grey list for not meeting our.
In fact, let's talk about that. That whole concept of wash. What has resulted in it?
So wash, just to kind of explain what money laundering is when you've got illegal proceeds of crime or situations that you shouldn't have money from, and you run it through different systems to wash it so that it can get back into circulation. So for instance, I might open, like you said, a hair salon, which never has people. But what I'm doing to boost... In
your books, you're doing 100 haircuts a day.
Yeah, I'm doing 100 haircuts in my books. But what I'm doing with that is just taking money out of like my box in the house and using it through the business to actually... Or you buy a bar that was doing 400,000 a month and now suddenly it's doing 4 million a month. Because some of these are cash transactions. So what it looks like is that the business has grown. And so that additional revenue, which is now proceeds, whatever you already had, is being washed back into the system so that now it can clean up.
Because I've seen some locals that are very empty.
But let me explain. There is something else about the Kenyan economy that's actually very, very unique. One of the things that people don't realize is that we host multiple countries' economies in Kenya.
In what way?
The Somali economy is actually predominantly based in Kenya. The South Sudanese economy is also based in Kenya. And then thirdly, we also have what's known as a UN economy.
Exactly.
Right?
Yeah.
So there is quite a lot. I remember the news one day of the central bank governor saying there's so much money that we don't know where it came from and people can't tell. But the Somali economy is based in Kenya. And the Somali community is massive in business. I've got
and has invested heavily already.
Heavily. And what happens with you'll find like the Somali community, because of Sharia law, they get very limited in what they can invest in.
Correct.
Right? They can't buy bonds, man. There's no interest. They can't touch anything with interest. They can't invest in things that have interest as a component of them. So what ends up happening is, number one, they're huge economy in terms of both Somalia and the Somali diaspora, because I have a lot of clients in the Somali diaspora.
Oh, you do?
Some of them who, man, are even coming through Kenya to invest in Somalia.
Interesting.
Directly in Somalia.
Somalis in general. Sorry to cut you short, but I noticed they have very community-gathered investing. Maybe we could speak about that.
And so the community investing aspect of it was something I came across when I was writing a piece for a magazine that had asked me to look into the Indian community in Kenya, right? And from studying that and the Somali and the Ismaili community, I began to understand that this communal nature. So, with a lot of Africans is whatever your parents made, you actually are not supposed to consider it as your own.
You go and get your own.
Go get your own, and maybe at some point in the future, your folks might leave it behind to you, right? If they do that, if they don't sell it off, you never actually consider it as part of what you have. You have to start from scratch. But with a lot of like the Indian community, the Ismaili community, the Somali community, they think collectively. So when one of us makes it out, right? Like, my dad made it to where he is. It's not his things. his kids now come in to take over different aspects of it. So you'll find that, the grandfather in the community might have started with a hardware shop and then wanted to open a hotel, but the son took over the hotel. And so suddenly now they have a hardware shop and a hotel. And all this is family money. So it's not like the guy who owns the hotel is getting rich by himself, which happens with a lot of like the native African communities. He's contributing back into the pool. The second son wants to set up a garage. So they keep spreading this out, and that communal basis. And then secondly, what it does for them is, because they're very clan-based and family-based with I guess you've seen this, is that being from one clan is almost like a signed contract.
Correct.
There's no sense of, I'm not going to do business with you, as long as we are from the same clan, because our kind of discipline and social pressure for us to do business together. You and I might need to write a contract because of the fear of the justice system, the court system.
But for them, it's
very still within themselves, and so they tend to do business very, very quickly.
I will give them this: the Somali culture and the Indian culture is they don't split up their resources.
Yes.
Everything is sort of put in one pot, and we all build from that. Yeah. Versus if you look at a colleague of mine based in the Kikuyu culture, when he turned 18, he was kicked out of the house. All his brothers were kicked out. Now what happens is you have 4 different rents you're paying, 4 different businesses, 4 different expenses.
Your parents own properties that
Correct.
you'll be living in, but you're going out. Yeah, exactly.
This is now the Somali and Indian culture to some extent, where you've got 4 sons. They're saying instead of paying 4 different rents, let's get one big house. We do one rent, one expense stream. Everything is under us together. Let us use our resources together, our strengths, our unity to build up and grow. And that's how they become captains of industries. That's how they scale properties. They do a lot of these.
If you look back into their history, you'll notice that both of these peoples tend to have come from kind of oppressive situations. So like the Indian community being in Kenya, when the Indian community came into Kenya under the British, as administrators for the British colonialists, because they'd already taught like guys in India how to build railways and to do these things. So they took those guys and brought them here to do the same. And what it created was 3 classes of people in Kenya: the white man, the Indian man, and the black man, the African, right? And since the Indian community itself was never accepted fully as part of the colonial aspect, and was never fully, was an oppressor, was considered as part of the oppressor by the African, they ended up in a very isolated space. Same thing that happens with the Somali, because they tend to be refugees of Somalia. So they tend to come together as people who've been displaced from the place of origin.
Right.
And then that actually now creates these networks, because then they don't really have the ability to interact with anybody else. They can't use the Brits, they can't use the Africans. So they built very strong community.
Makes sense.
In fact, V.S. Naipaul, who's like one of the most famous Indian writers, said when he came to visit East Africa, he'd never seen like an Asian community that is so completely isolated from the rest of the community in which that they operate. And that was a function of, remember 1977, what's his name? Idi Amin.
Yes.
The 70s, and the whole kind of, we are coming for you guys. So that then kind of also reinforced that
mentality. Okay. That's actually a very unique perspective.
Yeah.
It's the same thing. It makes sense. Yeah, it does. Exactly.
The Jews have the same issue. Ostracized people in a country not of their own come together and actually build very strong communities for their own benefit, right? So there is that element of it that actually has boosted that kind of growth.
That's actually, it makes a lot of sense, and I agree with you 100%. Is the community aspect is driven from all these experiences that happen over the years, and then it stems to that. Now, if we look at an aspect in this. Maybe I will use myself as an example, right? And you mentioned psychology is also a huge play into it. Yeah. A lot of us are in this rat race, man. It is a rat race where you're trying to make ends meet, you're trying to be a success story, and then you just burn out. I mean, how does that aspect play into it? Like, when you meet someone like me who's telling you, dude, I'm just tired, man. I'm just burnt out on both ends, lighting the candlestick, doing a corporate job that's 9 to 9, trying to make this YouTube thing work. You've got your mom on top of you. When are you getting married?
When you get married, with grandkids,
I mean, I understand Just speaking with you briefly is
Yeah.
that you've given a lot of thought into it. How does that play?
Oh, not actually a lot of thought. I spent 2 years completely burnt out.
Really?
Completely, totally burnt out. The kind of, where you can't get up in the morning for weeks on end, you're asleep for 10, 14 hours. Forget the drag, but the actual inability to completely get up out of the situation. And so during that period of time, there was a lot of things that I had to learn about how to get out of these spaces. And it ties in very, very closely to the work that I do with finance. The primary reason why I do this work, the whole reason why I'm trying to get people to the place where they don't think about money, is because it allows them to pursue more creative interests that are not necessarily based on making a return on this. So if you want to do this podcast because you enjoy having these conversations and sharing them, you don't really care how many people see them, you don't really care about getting sponsors for this. If that's what you want to do because it gives you a level of satisfaction, what's happened is we're forced to price everything. We're forced to price, I want to play with my kids, but that's 3 hours. How much is that going to, cost me? Or I want to paint, I must be able to sell my paintings. I want to build Land Cruisers for myself, so I must build a garage. So this whole thing of being forced to turn everything into something that makes money has actually become such a massive challenge for all of us that we've lost the ability to enjoy moments of time. And burnout has three distinct three main traditional symptoms. The first is a sense of hopelessness, like you feel like it's not worth doing anything anymore, right? It just doesn't make any sense. The second is a loss of self-efficacy. Like you're not motivated. Man, you'll find that over the weekend, if you don't leave the house, you don't even shower, right? You just bum out on the couch, just zoned out completely. You want to get up, you want to go work out, but you're unable to actually motivate yourself. That's a loss of self-efficacy. And the third is usually a sense of annoyance at everyone. Like you just hate everything because it feels
you have a very short fuse.
Exactly, it's intruding on you. And the primary reason why we find that people are burning out is because self-care, taking care of themselves, has been something that has been stripped from us. And particularly over the last 4 years since the pandemic, when we started working from home and we lost the distinction of work and home. And now it just became one amorphous, my house is is where I deal with my investors, is where I deal with my children, it's where I deal with my dogs, it's where I deal with my partner. We don't have this separation of places. And so we have this, what feels like a continuous, pressure all the time. And so the lack of self-care is actually one of the biggest things that's actually driving.
So when you talk about self-care, sort of what tips should I encompass then? Because you're preaching to the choir when you I've had those instances where I've just been home. I don't want to meet anyone. I don't do anything. I have just no
motivation to
even
eat
get out
or even take care of yourself, right?
And the thing is, again, the reason I'm putting it out on YouTube is so I can hold myself accountable.
Yeah.
But then again, because at the back of my mind, I'm like, if I don't do A, B, C, and D, I've told the world I will do A, B, C, and D.
Yeah, exactly.
That is a motivation. But then how do we sort of then address the fundamental issues that are still lying deep within
yourself? So there are two types of motivators that will drive you. Extrinsic motivators, like you said, you've told the world and you don't want to embarrass yourself by not doing this, which is an extrinsic motivator, embarrassment avoidance. Or intrinsic motivators, which is, these are the things that I truly want to do. And I think that's now what we've lost as people, because we've just gotten so consumed with doing, we've lost the ability to be, right? You never get a chance to sit down and ask yourself, why is it that I actually want to do this? It's just that it's the next natural stage for what we are doing. And so there's that loss of connection with ourselves, right? Because in the private moments when we used to be able to sit and just hang out with our families, what are we doing? Filling it with social media, filling it with more content, filling it with more external material about what we should be doing, where we should be going, what cars we should be driving. That's should statement. Like the biggest cause of unhappiness in your life is the word should, right?
That subjective aspect of the third-party recognition.
Third-party recognition, even within yourself, asking yourself, why is this guy there and I'm not there, right? Comparison is the thief of joy. So there's been that invasion of all this information that shows us how we are inadequate and we're incomplete. And we've bought into it because it kind of reinforces it, because at the same time, everybody's complaining about being burnt out. Right. And so we feel like I'm not the only one who's going through this. And so we keep feeding that negative cycle because I'm not the only one who's burning out. And that collective sense, there's been global, the last 4 years have been traumatic for a lot of people. And not just in the sense of direct personal impact, but the whole thing of there's war in Israel, like that constant.
There's always something or the other just out there, right?
And so it feels like nothing is working, nothing is actually going to help you out, nothing is going to ever get done, because kind of that's what it feels like the world is doing right now. Larry Madowo, you've seen him all over social media now. Everybody is hating on him because everybody's saying, yo, stop embarrassing us. But Larry is telling the truth. People are dying. Everything is flooding, right? All these things are happening at the same time. So there's this sense of collective tiredness. Like, what the hell, man? Do I ever?
Everyone's just frustrated.
Right? And so there's the self-care components that now usually I'll talk about. And I'll tell people, fundamental one is get good sleep. Right.
Sleep helps. Yeah. In fact, I will say that 8 hours a day.
But the quality of sleep. The quality of sleep. So there is the routines that you need to follow. You can't be on your phone and then pass out and expect to have a good night's sleep. You need at least a couple of hours to kind of let your mind cool down. Those couple of hours now is when most people have the hardest times of their lives.
Yeah, because your phone is literally right next to you before you get to bed.
TV is over there. You're trying to sit down and calm your mind. So usually what I'll do, like in my case, in my recovery, and through a lot of the research into psychology, physiology, neurobiology, like a whole bunch of these things, spirituality, studying everything from the Quran to Buddhism to Christianity, just looking for something that made kind of help me get out of this. I came to understand that the connection with yourself, which usually comes from the ability to sit silently by yourself and listen to what's going on, is what a lot of people are missing. Because anytime people sit down, they feel guilty for sitting down.
So they try and distract themselves
or try and do something. But on top of it, there are certain key components. The first is sleep. Second is hydration. Most people don't actually realize the effect of water on your ability to function as a human being. And I mean proper hydration. So you're not just drinking mineral water. Do some ORS, some salt and sugar into it so that it has the sodium, whatever that's required to go through osmosis and all of these kinds of things. Nutrition is the third. Make sure that you're eating slow release carbohydrates in the case where you need energy, not fast release. So not your breads and whatnot. Do your sweet potatoes. Get some protein in. You need exercise as well, not just necessarily.
So habitual changes.
Yeah.
You need to implement.
And they need to be focused on you, not to be seen, not to be about getting onto the podcast, not about, and that's, I think, one of the things
you do beyond the veil of the screen.
Like, people are trying to get better, but they're trying to get better on social media, which is the weirdest thing anyway in the first place, because that's what's messing up the whole situation in the first place.
Because then beyond the screen time that you have, you're on your own with yourself.
Exactly.
Right? So you need to encompass
meditation,
journaling. Yeah, actually,
therapy. Speak to therapists, right? And whenever I tell people about speaking to therapists, everybody's like, "Oh, but I'm not mad like you." And I'm like, one, I'm not mad, but number two, it's actually really fascinating to get somebody who's explaining to you what's going on in your head, like why you're thinking a certain way and connecting it, helping you connect these things that are going on in your life with an understanding of how the human mind and the human heart work. So you now begin to understand yourself in certain ways that you hadn't known before.
I had a friend who was in fact, I'm still against the idea of therapy, but seeing a friend literally change his persona, how it bettered his relationship with a significant other, how he came to deal with situations. For example, he would always overreact and panic and was a very indecisive decision maker. And when he did therapy, which I personally even made fun of him for, it completely changed his whole outlook and his persona.
Yeah.
And now he's a more calm, more collected individual. His relationship is thriving. I found that actually really changed his outlook, and that gave me a new, fresh look at the way therapy would be. So maybe it's something I should consider. So just to summarize, if you're feeling burnt out, you need to look at yourself internally. You need to find a way.
It's not going to be a holiday that will solve it. It's a misalignment issue. Okay. It's usually a massive misalignment issue.
Physically, psychologically, we need to encompass.
So that you remember, as a human being, you have 4 different components: your mind, your heart, your body, and your soul.
You need to take care of those.
We, for most of us, existence is about mind and body, where we are physically present, what we are thinking about and posting on social media and talking about. But the heart, what we are feeling, and the soul, what we aspire to, we don't actually repeat those things anymore.
Perfect.
Yeah.
So I mean, we've wound down. We've talked a lot today. In fact, I think this was probably one of the lengthiest podcasts. But it's been a pleasure having you, Macharia.
It's been great being here.
Having this conversation. Yeah. I'm sure we'll find some episodes to bring you back in as well. There's a lot we can talk about.
Yeah.
Guys, I hope you enjoyed that episode of Coffee Pump. Please like, share, and subscribe. See you in the next one.